Physical Gold Fund presents The Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to our latest webinar with Jim Rickards in the series we're calling The Gold Chronicles. Jim Rickards is a New York Times bestselling author, and he's the Chief Global Strategist for West Shore Funds. He's the former General Counsel of Long-Term Capital Management. He's a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. So, Jim, welcome, and we're really glad to have you with us on a rather special day today.
Thank you, John. Great to be with you.
And we also have with us Alex Stanzik. He's the Managing Director of Physical Gold Fund. Hello, Alex.
Hello, good morning. Great to be here.
All right. So Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question. And as time allows, we'll do our best to respond to you. So, Jim, they did it. The Federal Reserve unanimously agreed to raise short-term interest rates by 0.25%, the first rate hike in nearly 10 years, based, they tell us, on an improving outlook for the U.S. domestic economy. Two questions. Did the Fed make the right call here? And why is such a tiny rate increase such a big deal?
Two great questions, John. They definitely did not make the right call. This is, I think, in the fullness of time, we'll look back on this as one of the great blunders in Fed history. And that's a major statement because they've made so many blunders that, it's kind of a long list. But this will be added to those, right up there with 1929 and 2008 and a few other occasions. But let me explain the reasoning behind that. I never like to, put out views without sort of getting into the analysis and the thinking behind it. The Fed should have raised interest rates I said 2009. Actually, in 2009, in an interview, I was asked, what should the Fed do now? This was August. I was on CNBC, and Joe Kernan asked me what they should do. And I said they should raise interest rates 25 basis points. Don't do it again soon. Signal that it's going to be baby steps, and, not every meeting is said. And that was exactly the policy that they enunciated Wednesday. I said they should do it in August 2009. If they had done that, and to pick a year, some people say 2010, 2011, that's less important than the fact that they should have raised interest rates years ago. If they had done that over the course of, say, 2010, 2011, they could have got interest rates up to, 1.5%, 1.75%, sit tight for a while if that was necessary. And today, they would be in a position to cut, which is what they should be doing. The U.S. economy is uncomfortably close to a recession, maybe going into a recession in 2016. You're not supposed to tighten into a recession. You're supposed to ease into a recession. We can talk about the easing toolkit, but if they had raised them when they should have, they'd be in a position to cut them today. And this is really Bernanke's fault, not Yellen. They missed a whole interest rate cycle. And the way interest rates interact with the business cycle and the credit cycle, traditionally, and it's over a long period of time. First, the economy, expands, gets a little stronger, unemployment goes down, labor market conditions get tight, inflation ticks up a little bit. The Fed's, watching, and then finally it gets a little too hot and they hike rates. But it's not enough. The economy is still growing. Inflation is still going up. Unemployment is still, labor markets are still tight. The Fed hikes again. They hike again. And then finally they cool off the economy. The economy peaks. It starts to go down. And then the Fed is watching again. And they're like, okay, now unemployment's going up. Inflation's coming down. There's more slack in labor markets. Oh, we better cut. And they cut. And then finally the economy picks up again. So think of that as just a classic sine wave. The economy grows, the economy shrinks, it grows, it shrinks. And the Fed tightens and eases and tightens and eases to try to smooth out the amplitude of those sine waves. Now, but the point is the Fed always follows. The Fed never leads. The Fed doesn't make the economy do anything. They just kind of tag along, or at least historically that's the case. They're always behind the curve, and that's sort of the way they view their job. This is the first time that maybe ever. There might be one or two examples, although they're not too encouraging. When the Fed's trying to somehow lead the economy into feeling good, I mean, all of the data indicates recession or heading towards recession or contraction or significant slowdown in growth. That's both globally and in the U.S. We can talk a little bit about the data as well. So the Fed's just whistling past the graveyard. They're trying to raise rates. Well, they did raise rates, put on a happy face, talk about strengthening the U.S. economy, but it's completely a case of putting the cart before the horse. The Fed's supposed to see strong data and then raise rates. Instead, they've raised rates because they expect to see strong data. That's not how it works. So where is this outlook coming from? I mean, what kind of question you could ask rhetorically is, what is the Fed thinking? Well, I think it's important to understand that Janet Yellen is only loosely connected to the real world. I mean, she is a big brain, model-based quant. She has never spent a day in her life outside of one of three places, Berkeley, the White House, or the Federal Reserve. She never had a private sector job, never run a business, never met a payroll, never, sat in a trading floor, had to, bet her capital or other people's capital on an economic outlook. She's never done any of those things. She's just, as I say, she's a quantitatively driven and, fairly liberal, democratic labor economist. I mean, that's who Janet Yellen is. And she has a model that says that when you get to 1% unemployment, you get to this level of job creation, inflation is right around the corner. And that model is based on something called the Phillips curve. I had thought that the Phillips curve was completely discredited by the early 1980s. In the 1980s, I thought I would, grow old and die and never hear the word Phillips curve again. But it's back. It's like, a zombie that's come out of the grave. Janet Yellen is giving speeches of an academic, scholastic bent mentioning the Phillips curve. And the Phillips curve is just the trade-off between unemployment and inflation. So when unemployment gets to where it is now, job creation is where it is now, you should expect inflation. So that's what she's looking at. The Phillips curve doesn't work. It has no empirical support. And even Yellen herself said, well, you can't just take the 5% unemployment rate and job creation at face value because, we all know labor force participation is at a 40-year low. And we're creating jobs, yeah, but, if you lose one $85,000 a year job in the oil patch in North Dakota, and you gain three $25,000 a year jobs bartending, you may have created net 2 jobs, but aggregate demand has gone down. GDP has gone down. So I got nothing against bartenders, by the way, and I think there's dignity in all work. I'm happy for any unemployed person who got a job bartending. But when I look at the mix of part-time and full-time jobs, look at labor force participation, look at what's going on in real wages, I don't see any strength in the labor market, number one. Number two, so the unemployment rate is a lagging indicator. It doesn't tell you where the economy's going. It tells you where the economy's been. And monthly job creation looks like it peaked last November. Now, yeah, we're still creating a couple 100,000 jobs a month, and that's a lot at an annual pace. I mean, I'll grant that, but it looks like it peaked last November. That is, well, not last November, but November 2014, so 14 months ago, and it's a lagging indicator. So I don't take any comfort from that. When you look at everything else that's going on, the bulls, they point to car sales, 18 million cars a year at an annual rate, and there I would point out that a lot of those car sales are being financed with the new subprime, which is auto loans that have completely relaxed the credit standards. And again, I'm happy for anybody who got a new car out of it, but a lot of that debt is not going to be repaid. That's at the outer limits. Inventories are piling up. They just brought a lot of pent-up demand forward with cheap finance and easy money, and those, as I say, that appears to be hitting the wall, and you see that in inventory accumulation. So take those things away from the happy talk crowd, and everything else looks pretty bad. I mean, the regional Federal Reserve raised industrial output. The thing that is the scariest statistic to me is that world trade and U.S. trade are collapsing, and in the absolute sense. Now, most analysts look at trade surpluses and trade deficits. Does that contribute or detract from GDP? An interesting question, but forget about the surplus or the deficit. Look at the absolute level of imports and exports. That's going down. That very rarely happens. Trade deficits and surpluses bounce around based on terms of trade and exchange rates, but you never see imports and exports going down at the same time. You did see it in the Great Depression, by the way, and Charles Kindleberger did a lot of great scholarship on this. But it's happening in China. I was advising a group of clients from one of the world's largest banks about a week ago, and their chief U.S. economist, good guy. We probably disagreed on a few things, but he was in the room, and I made the point that I just made on this call, and he raised his hand and said, well, that's true around the world, it's true in China, but it's not true in the U.S. And the next day, the U.S. trade figures were released, and it was true. Both imports and exports went down. So look at container shipments, look at Baltic Dry Freight Index, transportation indices. There are just lots and lots of data points, all of which are very meaningful. So I would summarize the difference between Janet Yellen and me is Janet Yellen lives in a model-based world, and I'm trying to live in the real world of people actually buying stuff and shipping stuff and making stuff. And so it looks like we're heading into a recession. I would have said that even if they didn't raise rates yesterday, because the fundamental economy is not that responsive to a little rate hike here and there. I mean, I think the Fed blundered, but 25 basis points by itself is not the difference between a recession and an expansion or continued expansion, but I think it certainly doesn't help. Now, just to kind of spend a couple of minutes on the path, the Fed gave us some pretty good guidance of what they think is going to happen. I'll just caveat that by saying what they think is going to happen is not what's actually going to happen, but let's talk about what they think is going to happen. They said they'd like to raise interest rates 1 percentage point a year for the next 3 years in 25 basis point increments. Well, so that's 4 25 basis point hikes a year if you're going to do 1% a year, and they meet 8 times a year. So implicitly, it would be every other meeting. They didn't say that in so many words, and Yellen was clear, careful to say that it's not on a strict calendar and it's data dependent. Okay, fair enough. They always say that. But expectationally, you would say 25 basis points every other meeting for the next 3 years. And if you do that, you'll get to 3.25% by the end of 2018. Steady Eddie, easy breezy. That's kind of how they see it. And in the short run, what that means, and what I do expect based on what the Fed is saying, is that they will not raise interest rates in January. There is no meeting in February. The next meeting is March, so you would expect a 25 basis point increase in March. Then nothing in April, no meeting in May, and then raise 25 basis points in June. So I think that's kind of baked in the pie. You look at a 25 basis point hike in March, 25 basis point hike in June. We'll get to the 4th of July, and the floor on Fed funds rate will be 75 basis points. That's when it gets interesting, because if the economy is fundamentally weak, and a lot weaker than the Fed thinks, and their models are obsolete, which is my view, and some of the trends that I just described play out, they are in a pretty tight, rigorous tightening cycle right into a recession. You don't raise rates in a recession. You're supposed to cut rates in a recession or do some other easing, use one of the other easing tools. And for people who say, well, until Wednesday they were at zero, how could they cut? There are a lot of other things they could do. First of all, they could go to negative interest rates, which interestingly Janet Yellen mentioned in her press conference. She didn't say they were going to do it, and I think it's a very high hurdle to doing that, having to do with you would pretty much destroy the money market industry, which is $1 trillion industry, and they don't want to do that. But the fact that she even mentioned it as something they're researching and thinking about is pretty interesting. So you can go to negative interest rates. You can do more QE. Unlikely, because, again, that's been pretty discredited, and the research is sort of showing that QE doesn't work. You could do currency wars, try to cheapen the dollar. Well, that's not on the table now. I mean, if you're raising interest rates, which they are, you're making the dollar stronger, which they are. So currency wars aren't in prospect. They could do forward guidance, and they're kind of doing a version of that. I mean, think about what they're actually saying. They're raising rates, which they did on Wednesday, but they're telling you that it's going to be a very slow tempo of further rate increase. Okay, well, that's a form of forward guidance. Whenever you talk about what you're going to do next, as opposed to leaving the markets guessing, that's forward guidance. And so they're tightening and easing at the same time. They're tightening by raising rates, and they're easing by giving you forward guidance about not raising rates. If that sounds a little schizophrenic, it is. I mean, China just went through something similar. Until August, China was easing by lowering reserve ratio requirements and interest rates. but they were tightening by trying to maintain a peg to the U.S. dollar. The way you maintain a peg when the market wants your currency to go down and you're trying to put a floor under it and maintain a peg, the way you do it is by printing money, by using reserves to buy your own currency. So the People's Bank of China was, using dollars to buy yuan to maintain the yuan-dollar exchange rate. Well, when you buy yuan, you're shrinking the money supply. That's a form of tightening. So China was easing with two policy tools, interest rates and reserve ratio requirements, and then tightening with another policy tool, which was buying the yuan at the same time, which made no sense, and that was non-sustainable. And we saw that in August. It wasn't, something's not sustainable, it won't be sustained. So what happened in August? This shock devaluation. I mean, they had to do it. China was losing their reserves. They've lost $600 billion of reserves so far this year. They were going to be broke by, assuming that continues at not at a linear pace, but at an accelerating pace. China was going to be broke by the end of 2017. $4 trillion sounds like a lot of money until it starts to walk out the door at an accelerating tempo, and then it's never enough. So they would have been at zero reserves by the end of, my estimate, 2017 if they didn't do something. Well, of course, that was not going to be allowed to happen. So they did do something, which was they cheapened the yuan. But the way they did it was to shock the world, caught the world by surprise, caused U.S. stock market correction. U.S. stock market, we all remember, August 29, 30, 31, and it was just falling into the abyss. And then the Fed didn't raise rates in September, and that was then started the happy talk and dovishness, and then markets stabilized, and suddenly it's all good now that they did raise rates. So, but guess what? China's back to devaluing the yuan. They just learned a lesson. They said, don't do it all at once in one day when the market's not looking. Do it in baby steps, and the yuan has gone down against the dollar 12 days in a row, and look out for 13 days in a row starting Monday. So, but little tiny steps, and they're continuing that. So something that was non-sustainable in China wasn't sustained, and they're not going to close the capital account because it'll anger the IMF, and they're not going to give up independent monetary policy because they want the ability to cut rates when they feel like it. They caved in on the pegged exchange rate. There's, of course, capital account, exchange rate, monetary policy, the three corners of the so-called impossible trinity, which was theoretically developed by Mundell in the early 60s. So, as I say, you can't have all three on a sustainable basis, so they threw in the towel on the exchange rate. Now, back over to the United States, the U.S. is a little less vulnerable to the impossible trinity because we don't really need reserves because we print dollars. But the Fed is now on a non-sustainable path, meaning the Fed says they want inflation. That's no secret. They want 2% inflation. The Fed thinks they see inflation coming because of this flawed Phillips curve analysis that they're using, even though a lot of data points in the opposite direction. When you raise rates, you strengthen the dollar. A stronger dollar is deflationary. So if the Fed wants inflation, why are they pursuing a policy that causes deflation? That makes no sense, and it doesn't make sense. So they're on the same non-sustainable path. So the question is, when will they cut? When will they ease? Now, this is where, again, if you follow this path, hike in March, hike in June, get 75 basis points by the 4th of July, where do we go from there? This is where it gets really sticky because Larry Summers did a great analysis about a week ago in an article in the Financial Times. He did a bunch of regressions, and he said, historically, when the U.S. economy goes into a recession, it takes 300 basis points of cuts to get out of the recession. And that's how much the Fed has to ease to get the U.S. economy out of a recession. So, if you start at the recession at 6%, you got to cut to 3%. Or if you start the recession at 5%, you got to cut to 2%. Basically, you have to take 300 basis points to 3% out of Fed funds to give the economy enough of a lift to get out of a cyclical recession. But how do you do that if you're at zero? How do you do it if you're 25 basis points? So you can understand the Fed is now in a desperate race, and this explains why they hiked. I just went through a whole analysis about the U.S. economy's weak, probably heading into recession. They missed an interest rate cycle that they should have raised in 2010. What on earth are they thinking raising now when they should be cutting? Well, what they're thinking is, first of all, we're not going to have a recession, and I would point out that the Fed has never correctly forecast a recession. They don't get that right. They've never seen a bubble, and they've never seen a recession. Of course, bubbles happen and they pop. Recessions happen like clockwork, but the Fed has never accurately forecast either one. So the fact that the Fed doesn't see recession means nothing to me, but that's kind of how they're looking at it. Well, think about what they're doing. So they're going to raise 1% a year for the next 3 years. That gets you to 3.25% by the end of 2018. Then, if you had a recession in 2019, you could, following Larry Summers' lead, cut 300 basis points all the way back down to 25 basis points from 325 and get the U.S. out of the recession. Does anybody think we're going to get to 2019 without a recession? I don't think we're going to get to 2017 without a recession. Now, just to talk about that a little bit, this expansion has been the weakest expansion on record. It's been going on since 2009. It's almost 6.5 years old, but it's been so weak that if you talk to everyday Americans, they don't even think we're in an expansion. They somehow think we're still in the recession, and for them personally, they may be right about that. But we're actually in the 79th month of an expansion. The average expansion since 1980, which is a period of long expansions, right? Because you had the Ronald Reagan, George Bush 41 expansion of the 1980s, and then you had the Bill Clinton expansion of the 1990s. So post-1980 is a period of very long expansions, and the average post-1980 is 78 months, and this expansion is 79 months old. Now, that doesn't mean it ends tomorrow. I mean, the old expression, recession or expansions don't die of old age. It's true, but they can, as someone has pointed out, they can be murdered by the Fed. And so we're, no matter what you think, we are certainly in overtime in terms of this expansion, even though it's fairly weak. So how on earth do you get to 2019 without a recession? That's kind of hard to imagine. And so the Fed is in a desperate race to get, they're hiking to cut. That's the best way to understand this. They're hiking to cut. They're trying to get to 300 basis points. That's the Larry Summers bogey. So they can cut 300 basis points to deal with the next recession. They're not going to get there. We're not going to make it to 2019. So the Fed's going to come up short. In fact, if you think of it as a recursive function, they're hiking so they can cut, but the hiking itself makes the recession more likely, and they're going to have to cut more, and they're just not going to get to their goals. So they're hiking into weakness. It's not dispositive by itself, but it's going to make the weakness worse. It's certainly going to be deflationary. The U.S. is a sponge for all the deflation in the world. So, and just to kind of step out of the U.S. economy a little bit, let's look at the global situation, because this idea that from 1989 to 2008 we were globalized on the way up, but we're not going to be globalized on the way down is nonsense. I mean, there's no decoupling. So Brazil is in a very severe contraction, worse than a recession. Russia is in a recession. Japan's in a recession. Canada is close to one. The U.S. is probably close to one. China is not technically in a recession, but they're, when you take growth over the last 6 years from 10% to 9% to 8% to 7% to 6.8%, and then add on the fact, those are the official numbers, then add on the fact that 45% of growth in China's GDP is from investment, and at least half of that is pure waste. I mean, just pure waste. I've been to these ghost cities. I've been on the ground in China, and I've seen them. If you were applying anything remotely resembling generally accepted accounting principles, you'd write that off. So if you subtract another 2 or 3 points from the reported figures because of wasted investment, you're talking about a collapse in growth from 10% to probably 3.5, 4 at best. I'd say 3.5 is a better estimate. So that may not technically be a recession, but the impact on global growth is greater than a recession anyplace else because they're such a large part of global GDP. So you take 40% drop in something that's almost 15% of global GDP. I mean, you're taking 6 points out of global GDP over a period of years. Global GDP growth is only about 3.5% to begin with. So of course that's happened incrementally. That's over 6 years. But even if the year-over-year impact is closer to 2%, you're talking about taking global growth down to sub 1%. So that's the environment that the U.S. is operating in. And I already talked about contracting world trade, contracting shipment, Baltic Dry Freight Index, regional reserve bank surveys, declining industrial production. I mean, just a long buildup of inventories, long list of things. So now let's just take it forward. So now it's July, August 2016. My expectation is by then this negative recessionary data will be so strong that even the Fed can't ignore it. I mean, we can see it coming now. Wall Street will probably wake up to it by the summer, and the Fed will be sitting there in August, September saying, looks like a recession, or looks like we tightened at the wrong time. But then what do you do? Well, you could start an easing cycle at 75 basis points, but you're going to be 60 days from the election. If the Fed cuts rates 60 days, and bear in mind, Janet Yellen's a Democrat, if the Fed cuts rates 60 days before an election, I mean, Ted Cruz will burn down the Fed. You won't have to rely on egg farmers or everyday Americans. I mean, some of the Republican candidates will do it for you, and so they're not going to do it. It's just too political. What if they cut rates and the Republicans won? I mean, first order of business in January 2017 would be abolish the Fed. So they're not going to do it. So they've tightened into weakness. They'll tighten a couple more times. The weakness will be evident by late summer. At that point, they'll probably feel like they should cut, but they won't be able to cut because of the election. And we're going to get all the way to December 2016 with an overly tight monetary policy in the teeth of a recessionary, deflationary global economy, and probably U.S. economy as well, with a super strong dollar. And it's just going to be a mess. And at that point, they're going to have to go back to easing. Now we're talking, late 2016, early 2017, probably starting with forward guidance, and then back to zero by, the middle of 2017. And that we've seen in 8 major economies in the last 5 years. 8 major economies, including Japan, Sweden, Norway, and others, have, and Europe, European Central Bank, have raised rates only to cut them again. They thought they could raise on some kind of economic boost, some kind of economic expansion, and within months or a couple of years at the most, they cut them and they're back to zero. So, I saw a poll the other day. It said some high percentage of, U.S. economists think that the Fed will raise and then get back to zero within 5 years. And my reaction was 5 years. Try 5 months. Now, it won't be 5 months. It'll probably be, 15 months. It'll probably be early 2017. But they're going to get up to 75 basis points, 2 more hikes. Hit stall speed. The economy's going to start to, either go into recession or be very, very weak, and then they'll be back to zero by, like I say, by early 2017. So that's the big picture. That's my analysis of the Fed blunder. That's the data behind it. The explanation. What was the Fed thinking? Well, there were 3 reasons for hiking on Wednesday. Number one, which has nothing to do with economics, it was just Fed credibility. They said they were going to hike by the end of 2015. They went 7 meetings and didn't do it. They got to the 8th meeting of the year, 16 days before the end of the year. If they didn't hike in December, what little is left of their credibility would have been in the shredder. So they just felt they had to do it. Economics, who cares? They just had to do it to maintain institutional credibility. So that was one of the reasons, which is not a good reason, but they painted themselves into that corner by saying last year that they would raise this year. And why did they say that? Because they had the same flawed models they're using now. But that's their problem. The second reason for doing it, they didn't say a lot about this, but they have mentioned it from time to time. And Jeremy Stein, who was Fed governor, who resigned about a year and a half ago, was a leading voice on this. Although I think he resigned from the Fed because he didn't want to be around when this happened. Is letting the air out of asset bubbles. Now they always use the metaphor of letting the air out of a balloon slowly, but that's never what happens. It's more like hitting an overinflated balloon with a sharp object. It pops, it explodes. Just as the Fed never sees a recession, they never see an asset bubble. But there is this notion that, maybe stocks are in a bubble, maybe the bond market's in a bubble, commodities certainly are not in a bubble. Emerging markets, dollar-denominated debt, high yield, there are a lot of bubbles to go around. Maybe residential housing in the United States for that matter. So they think let the air out of the bubble. I think they could, one more rate hike in March, and they could just be hitting it with a pin. So look out below there. The third reason, of course, is this, which we talked about, which is hiking to cut. So we're hiking rates so we can cut rates. Just to say it shows how nonsensical it is. Like, if you're hiking rates to cut rates, why don't you just leave them alone? That's not what they're thinking. They think they've got time. They think they can get to Larry Summers' 300 basis point bogey before the next recession, and I'm like, sorry guys, it's 2019. You're not going to make it. So the three rationales were hike to cut, maintain credibility, let the air out of bubbles. My response is, it's too late. You should have hiked, 5-6 years ago. Bubbles don't deflate, they pop, and your credibility is pretty much in shreds anyway, and you're going to lose more credibility when you have to go back to zero in 2017. But that's a story for another day.
You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.